Hello and welcome to our event today, and a particular welcome to our speaker today, Mary C. Daly. As you know, and let me do the formal introduction and list of her bio. As president of the San Francisco Fed, Ms. Daly serves the 12th Federal Reserve District in setting monetary policy. Prior to her current role, she was the executive vice president and director of research at the San Francisco Fed, which she joined in 1996. Ms. Daly has served as an advisor to the Congressional Budget Office, the Social Security Administration, the Institute of Medicine, and the Library of Congress. She's also been a visiting professor at Cornell University and the University of California, Davis. Today, we're going to talk about central banking and particularly the balance sheet element of it, which we will then have our usual question and answer session. Most of the audience is online. Those people online are also welcome to put questions. I'll pick them up here and we can put them to the president. This address is on the record, as will the Q&A. So without further ado, thanks again for joining us, and we look forward to your presentation.
Well, thank you very much. And thank in February of 2020. And all of the conversation, of course, was how bad will the virus be, and will it turn into something very worrisome? A month later, we all knew the answer to that question, and central banks and governments across the globe responded robustly to ensure that the crisis of health didn't turn into a larger and longer crisis of economies. Now, luckily, those things are behind us now, but we have lessons that we've learned, in particular one that still stays with us and I think is important to highlight. And that lesson is that we live in an ever-changing and often quite surprising world. And nations and institutions and central banks have to respond by being agile and prepared, always thinking not about what just happened, but also what could happen and how would we be ready. So when I think of it from a central bank perspective, I think that we must adapt and change to meet our goals in good times and bad. Not just thinking about the good times, not simply thinking about the bad times, but to be able to meet our mandates, whatever your mandates are, whatever your jurisdiction is, in both good times and bad. And that means modernizing our tools and our operating frameworks, how we approach our monetary policy to achieve those goals, no matter how the world evolves. Now, I will submit that over the past 2 decades, central banks have done just this, using their balance sheets, among other tools, forward guidance is another tool, to support the economy during both the global financial crisis and the pandemic. And that work, the details of that work, have been largely successful. But it is only part of the job. Our other responsibility is to explain what we've done, where it has worked, where it hasn't, and how it will inform us for future actions. So today I'm going to talk about monetary policy implementation, how central banks operationalize their policies to support the economy, provide liquidity, and foster financial stability. The key message I'm going to give you is that no tool or tactic is perfect, no implementation framework foolproof. Each involves trade-offs, and all must evolve and change as the economy does. This is what decades of monetary theory have taught us and what modern central banking demands. In my mind, it's also what the public expects. It's what the public expects of all institutions. What's really interesting to me is that, I wondered if monetary policy implementation might be a topic that only central bankers wanted to discuss. But when I arrived Sunday to the UK, it was in the newspapers, and people were worried about these things. When I'm in the United States, people who don't really think about central bank details of financial intermediation ask me questions about it. I haven't been asked a direct question here about it yet, but I'm sure that today will be an exception. We'll continue that trend, rather. So before I go farther, let me just say that I need to remind you that these views are my own. They actually do not reflect anyone else on the FOMC, in the Federal Reserve. And since I'm speaking about central banking, I'll just extend that to central banking more generally, which I think the governor will appreciate here. So to think about central banks, we set our monetary policy in accordance with our mandates. And our mandates are given to us by the jurisdictions that we serve. And then we implement these policies based on a set of principles: interest rate control, liquidity provision, and supporting financial stability. And those principles might differ a little bit from jurisdiction to jurisdiction, but largely those are the things that define how we would go about implementing it. So for most of central bank history, this could be accomplished, achieving these goals and maintaining the stance of policy and liquidity, could be accomplished with small and stable balance sheets and management of scarce reserves. So scarce reserves, or reserves in general, in case you would like a refresher, are the cash and central bank deposits held by financial institutions. Our balance sheet liabilities at central banks mostly reflected then currency in circulation, required reserves for commercial banks, and official government accounts. But that was not a perfect system. With scarce reserves, private banks had to compete for a key operational resource: liquidity. And they relied on each other, what we call the interbank markets, to manage much of their short-term cash needs. And since reserves were, from a private bank's mind, idle resources, they only kept a minimal stock of them to meet regulatory requirements, meaning the banking system overall had a very limited aggregate buffer of liquidity. Now, frankly, this worked pretty well in normal times, but it was much less resilient in times of stress, when interbank markets faltered or macro shocks led banks to need liquidity all at the same time in order to meet their simultaneous customer demands. These vulnerabilities that I just mentioned, they played out in the global financial crisis. Stresses rose, liquidity dried up, and most central banks needed to provide emergency support to repair disrupted financial markets. You might remember those times. Central banks bought government securities and other assets to flood the system with reserves and meet the broader demand for liquidity. But as you might remember, asset purchases weren't limited to repairing market functioning. Facing a financial crisis and the zero lower bound on interest rates, when most central banks just couldn't lower their interest rate anymore, they also used, that is, central banks, used asset purchases to support monetary accommodation and the economy. These interventions worked, and they lessened the impact of an already severe crisis. And this is something there's been a lot of post-mortem studies on, and is basically a consensus that this worked, these interventions worked, and they softened the severity of the crisis, which was still very severe. Central banks took a similar approach to managing the pandemic, providing reserves for market functioning and monetary policy support for a weakened economy. And again, these interventions were successful. So then, and here's the point of the talk. So then, what is the problem with balance sheets? Why are they in the newspaper? Why do I get asked when I'm out in the United States? Why are they on people's minds at this point in time? It said simply, why are there so many critics or concerns? So I would like to offer 3 reasons and speak about each of them in turn. So the first reason is that central bank balance sheets are much, much larger than they used to be, creating a concern that central banks are playing an undue role in shaping the economy. Now, it is true that balance sheets in central banks have grown, and I think you can see this picture here. It says this is central bank assets as a share of GDP for the Federal Reserve, the blue line, the Bank of England, the green line, and the Euro system, the yellow line. And they've expanded rapidly since, if you mark it by since before the financial crisis. They've grown in part to do the 2 things I just talked about: support the economy during the GFC and support the economy and market functioning during the pandemic. If you want to just think about those numbers, balance sheets reach roughly 45%, 65%, and 35% of GDP in the United Kingdom, Eurosystem, and United States, respectively. So the blue line, the green line, and the yellow line. Now, they've come down since their peak, as you can see from the chart, but they remain larger than before the financial crisis. And this is where things get complicated. In nominal terms, balance sheets will likely never return to pre-GFC levels. They'll never go back to the levels they were at in 2005. And that is because central bank liabilities, other than reserves, other than the things we control, have also been growing. The best example I can provide for this is that currency in circulation, which is a core liability to a central bank, has increased roughly threefold over the past 2 decades in the 3 jurisdictions shown on the chart. The other large liability that central banks hold that is not something that we control is government accounts. And the government accounts, like the checking accounts of our governments, our treasuries, those are influenced by how national treasuries want to receive and make payments and how much of a buffer they would like to have on hand. So this has also grown, and this growth has been a particularly important part of the Federal Reserve's continued size in the balance sheet. Now, as I just said, importantly, neither of these 2 liabilities is controlled by central banks. We just facilitate, we do not choose. And so they expand naturally as the economy expands, and there's very little that we can do to make that lower. This means that central bank balance sheets will continue to grow over time, even if we don't do any interventions for financial stability or liquidity or monetary policy. So the second reason that I think there are concerns about the balance sheet is that the balance sheet, as you'll see over there, rise really rapidly and fall very slowly. So you can see the ramp up has been even more dramatic than in the financial crisis, which was over a longer period of time, very rapid in the pandemic support. So it goes up very fast, but it comes down very slowly. In crises, so I'd like to explain the reason why that happens. In crises, central banks provide immediate relief and sizable support to try to stave off calamitous outcomes, worse outcomes. And since financial markets are already challenged, they're already disrupted, dislocated, depending on the severity, the impact on market functioning and the economy is only beneficial. You're going in to fix something that isn't working, and so the interventions can help repair these financial market disruptions. But the reverse is not usually true. So when markets have improved and they're healthy and they're functioning normally, central banks traditionally have to be a little more careful, reducing balance sheets only gradually to avoid disrupting market pricing, to avoid being a footprint that creates a distortion. As we gain more and more experience, of course, and markets do as well, balance sheet normalization could proceed more quickly. But it's unlikely that it will be as fast as the run-up. And so you'll always, in all likelihood, see a fast run-up and a slower decline. And the third reason that balance sheets often draw criticism is that it's typically quite unclear to the public why they are changing. Now, that is understandable because balance sheets can serve multiple purposes, including emergency liquidity provision, like when you have the interbank market struggle or counterparty risk, as in the global financial crisis. But they also have policy accommodation aspects to them when interest rates are near zero. They can support overall financial stability if you want to keep more reserves in the system in general, like in the United States, where we've moved to an ample reserves regime. And it can also be effective for interest rate control. So that's 4 purposes. In many cases, these purposes get intertwined simply because you're doing many of them at the same time, or they're going in an order that makes it quite unclear to the public which one is driving which one is rising and for what purpose. So this makes communication, in my mind, essential, acknowledging the multiple uses and, when possible, identifying how each is driving the balance sheet growth. So facing all of these concerns, these 3 concerns, what should central banks do and perhaps do differently, or just more of the same? First, we should assume that people want to know, that the public is interested in things that affect their lives, livelihoods, and the economy. It's better, I think, to explain our actions than to assume that our actions speak for themselves. Providing detailed and abundant information improves understanding, and respects the public's ability to judge. Something I learned after the global financial crisis and then again in the pandemic, and you know it, but you really see it when you go through crises, is that people do want to know. And when they don't have an understanding, it's up to us as central bankers to do a more consistent and better job of explaining. So the second thing that I think is important for us to do is to show our work. And that includes explaining again how we balanced the costs and benefits of competing actions and why we settled on the decisions we made. So it's one thing to do a textbook explanation of why things might work, but I think it's really also interesting for people and important for people to hear we considered this and didn't take it, and we considered that and took it, and here's why, here's the reasons. A key lesson, I think, especially over the last 30 years from central banking research, is that transparency of central banks improves accountability, which ultimately increases our credibility and improves our monetary policy transmission. Our policies work better when people know what we're doing and they trust that we have identified the right policy choice for the right moment. And then finally, we should be willing to change. Tools and tactics used in emergencies teach us a great deal, but they do not become a playbook for all events. And so we must distinguish what works in normal times from what works in times of crisis or constraint, and be clear about those lessons. I think what's really being asked of us in currently, at least in the United States, is if you've got a policy that works, would you use it all the time or just in special circumstances? And what would those special circumstances look like? And so I think the burden is on central banks to explain, when do you use these policies versus those policies, and how do you go forward with that? So ultimately, my bottom line message for today is that central banking has to rise to the public conversation, telling people what they need to know, revealing how we arrive at our decisions, the how being really important, and being willing to change when experience or the economy demands it. To me, this is what modern central banking means. It means coming out. Now, I'd say for 30 years, central banks have been doing this at greater and greater degrees, and different jurisdictions do it differently and well. But I think modern central banking, as opposed to the central banking we might have read about early in our careers, is one that says policy is important and communication is as well. So thank you, and I look forward to our discussion.